Hello, everyone. Thank you, everyone, for joining us today. We are about to start. If you want to leave in the chat where you're from and from where you're watching us, we are happy to have you all here. And if you don't mind answering the poll that should appear on your screen, so we get to know you better and we know if you are already a Real Estate IQ subscriber and if you would like to have a one-on-one consultation of our services and a free demonstration of our portal. So we have Ravi Kaku with us today talking about qualifying with personal income versus property income. And we are super happy to have him with us today. So thank you, Ravi, for being with us today. So feel free, everyone, for sharing your questions on the chat and using also the Q&A box to ask Ravi all the questions that you may have during the presentation so he's able to answer them as soon as possible. So moving forward, we are Real Estate IQ. Your deal is our mission, and we are deal maker and dream maker, and we provide the best real estate solutions committed to help one more person to win. So make your deals come true. So this is a streamline your deal making process. So these are the solutions that we provide. We offer off-market leads. We provide daily updated lists Monday to Friday of motivated sellers to contact, get the freshest data mined straight from the card houses. We also offer EVA CMA. Run real estate comes in seconds with our renewed CMA. You can check each property's data, select the ones to compare, and get reports instantly. We also offer you custom leads mining. So if you're looking for specific area leads, look no further. We now provide custom off-market data mining all over 50 states. And last but not least, we also offer you virtual assistants, one solution for administrative tasks, customer service, and technical support to grow your business. Let's walk together toward your success. So if you're looking for more, please try our exclusive membership. These are our social media accounts where you can follow us as well. We are in Instagram, Facebook, LinkedIn, and YouTube. And you can use the QR codes that appear below of each icon. So you can join us in our community and you don't miss any of our weekly webinars and in-person events. You can also use the QR code that appears on the right side of the screen. So you can join us in our newsletter. And also, you can scan the QR code that appears on the screen so you can get a free 30-minute in-depth consultation of Real Estate IQ's services with one of our experts. So feel free to schedule it now. Also, you can get more information sending an email to bracenet@realestateIQ.co or also by answering the poll that should appear on your screen. So this is a very short video of what we do at Real Estate IQ. Okay, so I don't want to make you lose more time. Thank you again, everyone, for being with us today. Moving forward to you, Ravi.
Yes. Just want to make sure that able to see my screen.
Yeah, perfect.
Okay, awesome. Hello, everyone. My name is Ravi Kaku. I'm here to educate more on real estate investment lending in 2024 and a couple of specific programs that can help investors really grow their investment portfolio from where they currently are. Um, so a little bit about me, first generation Indian American, born and raised in Texas. I'm a husband and father of a 1-year-old. She just turned one a couple weeks ago. Very exciting for the family. I've been doing this for about 10 years as a residential mortgage loan officer. I'm also a direct private money lender for any rehab properties that you're either looking to fix and flip, buy and hold, or if anyone's interested in purchasing real estate notes. I've done that number should be updated, but 200 plus million in loan originations as well. So all that's just to say a little bit of experience on my side. Um, to start off, the biggest question, and every time I have a conversation with real estate investors, the first thing I ask them is, do they know their acquisition power? And these are the kind of the 6 questions I typically ask, or that we believe every investor should know as they start to get into real estate investing. How many properties can you buy now? So whether that's based on, again, your personal income or what you're about to learn today based on property income. One with personal income will essentially limit you on how much you can buy depending on Fannie Mae, Freddie Mac guidelines, where if you base it off of property income, that kind of expands the ability of how many loans you are able to acquire. How many properties can you buy in the next 12 months based on how much in assets you have, debt to income ratio, uh, things of that nature? How many properties can you buy over your career? Now, is that just with you, or is that with you and your spouse, you and a business partner, multiple partners? Uh, are you married? And if so, does your spouse want to buy investment properties? This question is important because of the Fannie Mae Freddie Mac rule. They only allow you to have 10 finance properties under your name. So a lot of our investors, they're taking advantage of this rule by just acquiring properties under one, like let's just say the husband is just acquiring properties under his name until he reaches that 10 limit, 10 property limit, to where they switch over to the wife. And now the wife is starting to buy homes under her name until she reaches. So instead of buying 10 properties together, now they have 20 properties under their name by just splitting it between the two. Do you have a sphere of influence that you can tap into? This is essentially, if you were to go into your phone, I'm sure you'd be able to find 2 to 3 people who would either be able to help you lend you money or provide you guidance on how to acquire properties, get you financing. There's a lot of information. There's a lot of influence that's already probably built into your phone right now. And then are you pre-approved with the investor-friendly lender? We do consider ourselves to be investor-friendly. All of us are investors within the company. We 50% of our business is working with investors. And the reason why that's important is we know how to qualify investor clients and how to find the right strategy for them to build that real estate portfolio. There's been some changes within credit scores this past year. Typically now 780 and above will get you the best rates. It used to be 740 and above. Now it's between 740 and 759 and 760 and 779. Now they've breaking the tiers down even more than the 30, 40 points that you see here. It's now by every 20 points. So typically, of course, the higher the rates, the better. Anything 620 or above will get you qualified for a mortgage. Of course, anything above a 680 or 700 will open up the portfolio of loans that you are able to acquire. Big update that happened last year with cash out refinances. This impacts investors more than really anybody else. There is a surge in equity or appreciation in values over the past 2 or 3 years. And then when COVID hit, a lot of people started taking cash out out of their home, equities out of their home. So what Fannie Mae and Freddie Mac did is that they've changed the seasoning where typically you used to have to be able to be on title for only 6 months to be able to do a cash out refinance. So a lot of investors, when they bought these rehab properties, they would fix it up. And then in 6 months, they would take the, 75, 80% of the value of equity out at that time. But now Fannie Mae, Freddie Mac is now requiring you to be on title for a whole year. So this impacts you a little bit to not be able to get a conventional loan, which again is based off your personal income. But the product I'm going to talk about today that's based off of property income, it's also called DSCR, will allow you to take cash out being on title for 6 months. So it is frustrating for investors and investor-friendly lenders like ourselves that they change this rule, but there are ways around it. So as an investor, you're typically going to want to know what are your financing options. These are the true 5 options that we see on a daily basis that we're able to provide as options to our clients. The first one is conventional lending. So these are the typical Fannie Mae, Freddie Mac loans. This is if you own a primary home, this is probably the type of loan that you got, whether it was conventional, FHA or VA, USDA. These are either government-backed or government equity entity loans that you can achieve. These are based on your personal income, qualifying credit score, debt-to-income ratio, certain down payment requirements. But those are typically they're going to have the lowest interest rates at the lowest cost as well. The second type of financing is called non-QM, non-qualified mortgage. These are your DSCR, property income loans, your bank statement loans. So if you're self-employed and if you were trying to buy a primary home or refinance or buy an investment property, do a cash out, and you've been denied because a lender said that, hey, your tax returns aren't showing enough income because you might have written off, which is, you have the full right to write off as much to lower your taxes. We have a program to where we look at your last 12 months or 24 months business bank accounts, and then we're able to generate your monthly income based on the average daily deposits over that span of time. So this helps gets clients. I just qualified a client that they were denied by multiple lenders. Now they were end up able to buy a $400,000 primary home because I was able to qualify them based off of that bank statement program. So they went from not qualifying for me being able to generate almost $50,000 in income for them. So now that they're only going to buy their primary home, which they did, now they're going to be able to buy multiple investment properties due to this program. There's also profit and loss programs and CPA letters. So if you are self-employed or a real estate investor, just know that there's programs out there other than traditional financing. The third option is commercial lending. So we don't typically specialize in commercial lending, but this is an option. These are like portfolio loans if you're looking to acquire multiple properties all in one, to put multiple properties into one loan as well, or to buy commercial properties. Number 4 is our favorite type of lending because that's our bread and butter of our company is private and hard money lending. This is for your rehab loans, for your fix and flips, for your buy and holds, because everything is based off the future value of the home. So if you are looking to get into real estate investing and are looking at rehab properties where it wouldn't qualify for conventional or non-QM lending or commercial lending because the property is not livable, is not appraisable, that's when you're going to have to use private and hard money lending. This is where you use other people's money. Instead of putting all your money into the one home, you borrow the money, yes, at a little bit of a higher interest rate, but it's for short term to help you borrow based off of a future value of the home and get 100% of the rehab money back to you. And of course, the fifth one is family, friends, acquaintances. This is like the sphere of influence I mentioned earlier. If you were to look at your phone, I'm sure there are a couple of people in there that if you were able to reach out to, would be able to either partner up with you for a loan or be able to provide you funding in case the other first 4 options aren't available. So today's about non-QM lending. So to kind of give you a breakdown of what that is, it's private and public institutional funds. This is like Wall Street or insurance money that's out there that they're looking for alternative income qualifications. So if you aren't able to qualify through your personal income, you can do so through the bank statement, through your property income. DSCR is one of my favorite loans. I help a lot of investor clients refinance out of our hard money or other hard money loans because investors may not typically show a lot of income on tax returns, or if they're just starting off and they've left their W-2 job, or if you have a W-2 job and you've maximized your ability to get Fannie Mae loans because they cap you at 10, this is the loan program that you're able to utilize to acquire more property. So, and I'm going to go into it a little bit. These are higher rates, 7 to 11%. You can get 40-year loans. You can get interest only loans on this type of program as well. The big thing here is there's no max finance properties. So you can load up on this type of loan program up to 15, 20, 25 loans. Now, you may not be able to go to the same, like I may not be able to take the loan to the same company. Being a broker, independent broker, we have multiple different companies that we can get the loan done at. So once we reach the max that one company will lend to you, we just move it to the next one. They're all the same guidelines. It's just now we're just utilizing a different institution to qualify for the loan. The other important thing is we are also able to close in your entity name. So any kind of conventional loan, they're always going to want to close in your personal name, and the title would have to be in your personal name. Where DSCR non-QM lending, yes, the loan is still under your personal name, but they allow you to close in your LLC for the title of the home. So this is for extra protection for investors in the long run. Now you can go up to 80% loan to value on these. Typically you'll be around 70 or 25% down instead of the 20%. And there are prepayment penalties. Now we have loan programs where there's not prepayment penalties attached to these loans. But if you are willing to take a 1 year, 2 year, 3 year, up to a 5 year prepayment penalty, your pricing does get better. So if you know you're going to be keeping this property long term, it could be worth, taking a 2, 3 year prepayment penalty on the loan, knowing that you're not going to be selling it at that time, because typically you'll get hit with a 1% penalty of the loan balance if you were to pay it off prior to that, the term of the prepayment penalty. So what is debt service coverage ratio? This is the property income that I was speaking about. So personal income, the way you get qualified for personal income is you take your gross household income and you take all your, that's how you would qualify. You take your gross, so before your taxes and insurance. But first you would take all your liabilities. These are your car loans, credit cards. You would be looking at all your monthly mortgage obligations like property taxes, insurance, HOA, and you take the new home, the new properties, same monthly payment. You would add up all those liabilities and divide it by your gross monthly income. And that's what's called your debt to income ratio. Typically for conventional loans, you have to stay below 45 to qualify. So then eventually that you will get capped on your purchasing power. So then this program called the debt service coverage ratio opens up for you, because this is strictly based on property incomes. Because when I submit loans for my clients, I'm not submitting any income documentation. So no W-2s, no paychecks, not even tax returns. Nothing on any of your other properties other than the subject property, whether you're trying to purchase it or refinance a home. That's all the documentation that we need. And so the way to kind of calculate what your DSCR ratio is, at the end of the day, it's whether your house property cash flows or not. But the debt service coverage ratio is your net operating income. That's essentially what is the rental, the lease agreement that you have on the home. So it's very important that you have a lease in place when you're trying to refinance under this program. When you're looking to purchase, it's not a problem. It's not an obligation to get a lease, because we can use what's called future rental income. The appraisal will get done and we'll do a rental income analysis in your market area to determine what is the market rent for this property in this area. So then we'll be able to use that amount for this calculation. But typically, if you have a lease in place, you would take that and you would divide it by the monthly principal and interest, your new mortgage payment, your monthly property taxes, monthly homeowners insurance, and any HOA dues. So if your rental income will cover all of that, that means your ratio is above 1%. That kind of opens up to better pricing and being able to refinance up to 75 or 80%. Whereas if your ratio is below, you still qualify for the loan. So if your DSCR ratio comes in at half because your rental income only covers half of the payment, then you can still refinance out of it, as your pricing is going to be higher. You may only be able to be qualified up to 70% on a refinance, or have to put more percent down, meaning you'd have to put 25% down when buying a home. But at the end of the day, you're still able to acquire the property because you still think it's a good deal. You still think if there's going to be good appreciation in the area, you'll be able to fix it up and sell it down the line for higher value. So you'll definitely want to take a screenshot of this. Again, it's your lease agreement or the market rent in the area divided by the monthly estimated monthly payment, including your property taxes, insurance, and HOA. So if your lease, again, will cover all that, pretty much you're good to go. If it doesn't, not to worry, we can still get you qualified for the loan. Because I can go all the way down to where if your DSCR ratio is 0, meaning you have no rental income on the home, we can still help you acquire the property or refinance out of a hard money loan as well. So to give you an example of how this works, let's just say a property is rented out for $2,350. So this is how you'd calculate for the debt service. So the mortgage includes principal and interest. So let's just say principal is 200, interest is 1,064, property taxes. If you take the annual property taxes and divide it by 12 to get your monthly amount, that's 450. Same with insurance, take your yearly premium divided by 12, and you have no homeowner insurance on this property. Your total liability or debt service is 1839. So now you're going to take your income 2350 divided by the liabilities 1839. Your debt service coverage ratio it's actually really good at 1.28. So now you're able to, if you were to buy this house, you'd put 20% down, you'd get lower rates, lower cost. This is the same if it was a refinance as well. So let's take an example on the other side, where your rent is only 1,300. Let's say your principal is 150, interest is 798, your property tax is 300, insurance 80, HOA is 50. So your total obligation on this home is 1,378. So it's not covering your lease. Your lease is not covering the debts on the home. So your coverage ratio is 0.94, which is still a good ratio, but it doesn't give you above 1. This will still qualify you for the loan, but you may end up having to put, instead of 20% down, you may have to put 25% down. Or instead of refinancing up to 80, you may only be able to refinance up to 75. Or if you're looking to do a cash out on one of your free and clear properties, you may not be able to take 75%. You may only be able to take 70 or 65%. Of course, all this is based on credit score as well. But you can see you can still utilize this program to still purchase an investment property, refinance, or to do a cash out refinance, even if your lease doesn't cover the full liability on the home. So let me give you guys a few scenarios of what I've recently run into and how they were able to utilize this program. So I had a client that had a change in income. So conventional lending doesn't accept this new structure. So I had a client that went from a W-2 job and they switched over to becoming self-employed. So a client was looking to buy an investment property. They got denied at multiple places because of this income change that they've had in their career. They were initially approved at 20% down, but they ended up having to put 25% down, and I'm going to explain why. So they had a purchase price of 465, down payment 25%. So their loan amount was 348,750. So again, this interest rate is a little bit older. This was from 2 years ago, but just to kind of give you an idea, the interest rate was 5.875. They did end up going interest only for the first 10 years. The loan had a 3-year prepayment penalty on it. The principal and interest on this was 1621, and then when you added in the taxes, insurance, and HOA, their total payment was 2,694. When we ordered the appraisal, the clients initially thought with their realtor and what they thought they could get in rent in the area was 2,800. So that's why initially the whole loan was set up for them to only put 20% down. But when the appraisal rental income analysis came back, it's called a 1007. So you order your appraisal and you order this additional form. So it costs about an extra $100, $150 to order this. The appraiser came back with only $2,600 that of homes that are similar to their subject property that have been rented out within the last 6 months. And they came back with 2,600. So based off of this, their income wasn't covering their full payment. So then the approval department they changed it to where they only qualified the client if they were to put 25% down. But the client was okay with that, because we ended up switching them over to this interest only. We lowered their payments, and I let them know that once they're 2 years of self-employment, once they have 2 years of tax returns, which should be coming up, I'll be able to refinance them out of that into a conventional loan. Now, of course, I wouldn't do that right now because of interest rates on conventional financing is a lot higher than what they have right now. But eventually, once rates drop, I'll be able to get them out of this loan, and hopefully, they're able to rent it out for the 2,800 they said they would be able to, because I can use that. Once you have it leased out, I can use that instead of using on a purchase what the appraiser says. That was a purchase example. This is a refinance example. Again, this was from 2 years ago as well. A client had a free and clear investment property, and they wanted to do a cash out at 65%, because their whole goal was that they had this property that they inherited, and they were sitting on this property for about 5, 6 years that was free and clear. That money essentially was dead equity. It wasn't making them any money. So they wanted to take it out and then use that to buy multiple other properties. The client was self-employed, they're a realtor, and they own 7 other properties. So again, initially they couldn't qualify, even though they were self-employed for 2 years, they had 2 years of tax returns. It's just all the properties that they owned. Of course, they wrote off a lot on their tax returns. On the Schedule E for the rental properties, they weren't showing income, so they were denied on the conventional financing side. So we took them into this DSCR loan program. So the appraised value came in at 255. The loan amount was 160, but I ended up changing it to 163,500 closer to the end, because that extra 3,500 was able to cover some of the closing costs, because they wanted a certain amount out. So you're able to increase the loan amount just slightly as long as it fits within the loan to value limits to help cover your closing costs. Because on a cash out refinance, you're not paying any of the closing costs out of pocket. The only thing you pay is for the appraisal, because everything else is paid through the cash out proceeds. So let's just say if you're getting 100,000 and closing costs were 10, you're only going to receive 90,000. But if you were to increase your loan amount to 110, now you cover the 10,000 in closing costs, and you're able to get the full 100,000 that you're wanting at the end. Now, this was initially disclosed at an above 1 DSCR ratio, so they were getting better pricing. So the interest rate they got was 8.75. They did take the 3-year prepayment penalty because they knew they were going to be holding this property. They've been holding it for a long time. They're going to keep it for a long time. The monthly principal and interest was 1283. When you added in taxes and insurance, it came in at 1965. Due to them not having this house rented out, I had to go based off of the rental income analysis that came in at 1900. And this is the reason, as you can see, the income came in low compared to the monthly payment. So what that affected, they were still able to get the 65%, but their interest rate, they ended up getting an 8.75, but initially they had 8.25. So yes, they ended up taking a 0.5%. But the way this investor was thinking is that, yes, their payment went up. It's unfortunate that you never want your interest rate to go up because of what the rental income comes back at. But they know that they were able to take the 150,000 or so that they received. And then she ended up went and bought 3 investment properties, rehab, like the Burr strategy: buy, hold, uh, rent, and then repeat, and then refinance, of course, is in there. But she was able to take this money and put that money to work. So yes, she has a higher interest rate on this home now compared to having a free and clear property. But she took that and ended up buying 3 other properties to then generate multiple streams of income with the cash flow on the 3 other properties. So to give you an idea of what today's conventional pricing looks like, if you were to buy a $300,000 investment home, your credit score was 760. This is to show you the difference of what 20 and 25% down looks like. Because nowadays, the conventional financing is just 20% down has always been the typical down payment, and you'd get decent rates, where of course 25% would give you better options. But nowadays, 20% is not even giving you decent pricing. You can still get away with putting 20% down, but 25% will end up saving you close to like $3,000 to $4,000 just in interest rate cost. So you can see in the first chart, 300,000 putting 20% down, your loan amount's 240. You can see the different interest rate options, 8.3, 8.5, 8.625, and your payments are 1824, 1845, and 1867. But you can just look at the cost. When you look at lender fees, we don't charge an underwriting or a processing fee for the first 4 loans. Anything more than that, we have to apply a processing fee just because there's a little bit more due diligence needed. But you can see the cost for just the interest rate is, close to $6,000 or more on each option. Now, if you have the ability and are okay with putting 25% down, you can see on the next chart that, of course, your loan amount's lower, so that automatically drops your monthly payment by close to $100 or more on each of these options. So now if you weren't cash flowing or if you wanted to cash flow a little bit more, you're able to generate an additional $100. But you can see the difference in cost. It's almost close to $3,000, $3,500, sometimes even $4,000 lower cost by just putting an extra 5% down. And I know what you're saying, or maybe you might be thinking, why would I want to put an extra 5% down where I can utilize that for maybe repairs or using that to buy another investment property, which is all very true. So at the end of the day, we're just here to kind of show you options that if you're okay with taking a higher cost because you're going to be able to recover these costs down the line through cash flow by holding the property, then definitely the 20% down is an option. If you are able to put the extra 5%, you can see how there could be a benefit by having that lower payment and a lot lower cost as well. Again, this is on conventional pricing. This is on DSCR. This is where, again, not qualifying with your personal income. This is just based on property income. Same scenario, 25% down. The key thing to look at is that the DSCR ratio is above 1. So what that means is you're cash flowing on the property through your rental agreement or the rental income analysis. This all has a 2-year prepayment penalty as well. So your first option, you see that rates are a little bit higher. These are in the 9s on the first at 20% down, and where the lender fees are. So lender fees are a little bit lower on the DSCR side because you're taking the higher rate. Whereas if you were to put 25% down, the extra 5%, you can drop. We're on conventional financing, your interest rate doesn't really change. Your costs just go down. On this DSCR option, your interest rates go down by almost 0.5% on each option. And then of course, your payment is also dropping by close to $200. Your fees are typically the same or relatively close. The big difference here is you're able to get a lower rate and a lot lower of a monthly payment by putting that extra 5% down on this program where you're cash flowing on the property. So again, this is just to kind of show that outside of conventional financing, there's still options to purchase an investment home. This is to show you the exact same scenario, but the key, if you look at the third option there, is that the ratio is below 1%. So you're going to see the huge difference from when it's less than 1%, you're going to also see that you have to put more down, 30 to 25% down. So of course, 30% is going to give you the lower rates. In this scenario, you can see the 25% down, the rates are a lot higher, almost 2% higher because it's not cash flowing. Your monthly payments are almost $500 more. So again, I don't know if it's necessarily worth putting the extra 5%, putting 30% down on a property. It's really depending on your scenario. Can you still cash flow at 25% down, taking these higher rates? Because at the end of the day, what all this really means is this is just to help you acquire the property. And then we're always going to look to refinance you once the rates drop to get you a lot lower rates so you can get back to either cash flowing or cash flow even more. But of course, you can see there's a drastic difference when your ratio is less than 1%. And how much you're putting as a down payment. Again, the main question I start off with is how much house can I afford? That's something you can always reach out to me, and by taking an application, it's very easy to determine what is your purchasing power. Again, it is going to be based off of your personal or property income. Personal income is based off of a debt to income ratio, where property income is just based on the rental agreement. But it's very easy to determine this. An application takes like 20 minutes, and I can let you know within a day. Because this is the main thing you want to know is how much house you can afford. So before you start shopping, or if you've already have 4 properties, you're trying to figure out, can I get that fifth one? This analysis kind of helps you determine that purchasing power. Using future rental income to qualify for a mortgage. This is really big in our industry. This is when you are buying a home, buying an investment property. A lot of people have come to think that they have to have a lease agreement in place to qualify, which is not true. Again, you can use the appraisal rental income analysis, which helps you qualify. So if you have a primary home, of course, you're going to get hit with that full mortgage payment. And then when you're buying a future home and you're like, oh, this property doesn't have it rented, it's not rented out, we will be able to use that future income to help essentially wash out that new mortgage to help you qualify for more homes down the line. So nothing to worry about when you're buying a property. You can't use this for really a refinance. You can if it's not leased out, and we can always use the market rent, but this typically comes into play when you're purchasing an investment property. If you were to visit our website, blinklending.com, let's just say if you were trying to go look for a property in the evening or over the weekend, you aren't able to get a hold of anybody at our company, you can go to our website. This is whether you're working with us or not. You can go to a link where you can get pre-approved instantly. You'll get a PDF sent to you that'll be a true pre-approval, because we have a formula-based questionnaire on our website that, based on the questions, the answers to those questions, our system will automatically generate a pre-approval letter to you. If it doesn't, then one of us will get in contact with you to analyze your answers and to see how we can come up with a better solution to get you pre-qualified, whether it's whichever loan programs that we have. So it's always important to be pre-approved prior to you going house hunting. This is my contact information. Feel free to keep it shared. I am based in Houston. The big thing is our company, we can lend. We're only able to lend whether it's conventional financing or private or hard money here in the state of Texas. The DSCR loan that I've talked about today, I can lend in multiple other states outside of Texas. Of course, when we get together and we talk, you can always shoot me your scenario, and based on the state, I can see if I can lend on this program. But yeah, conventional or private or hard money, I can only lend in Texas. But feel free to use me as a resource. If I can't help you, I'm always open to answering questions. It obviously, through education, it also helps me kind of sharpen my sword and being a little bit more expertise in my field. But that is pretty much it for me today. I'm going to see if anybody has any questions. I'm more than happy to answer them. I think, do you guys send a replay of this training? Okay, sorry. Yeah, I believe so. There is going to be a replay of this training. But if anybody has any questions about anything I went through, feel free to put in the chat. If not, that's pretty much it for my presentation.
So there, Ravi, Kelly is asking, can short-term rentals be used?
Yes, short-term rental is, so like, if you would ask me this question like 2-3 years ago, it is very tough. People didn't recognize, Airbnb or Verbo income, but now, as long as you have a history, at least 1 year history, we can use that as the short-term rental to help qualify for a refinance. And you can use DSCR to new construction. Again, that's being able to use that future rental income. So again, at the end of the day, whether you have to put 20 to 25% down, that'll be the difference. But you can definitely use this program for new construction for any investment property. You can even use this to go up to 4 units, fourplex. Anything more than a fourplex is considered a commercial loan. So then I don't really have a lot of options for that. But anything up to 4 units, whether it's a single family home, new construction, duplex, DSCR can be used.
There is also a question from Donna that says, what's interest rate for X credit on refill?
I'm sorry?
I don't know if you can read the question in the Q&A box.
Okay. What interest rate for EXC credit on refi? Oh, excellent credit on refi. So if we're talking about conventional loans, you're probably going to be in the high sevens to low eights as of today. On the DSCR side, you're probably looking into the high eights to the low nines right now. And excellent credit for us nowadays is 780 or above. How is it possible to finance conversion of commercial property into residential? That is tough. I mean, the property would have to be surveyed residential to be able to refinance into a residential loan. So as long as it's resurveyed and when the appraiser goes out there and does an appraisal and they mark it as best use as a residential property, then that's no problem at all. Then typically anybody will refinance that property for you. It's a great question, though. I think that might be all the questions on here. But yes, if anybody has any other additional questions or want to reach out with any specific scenario, please shoot me an email or give me a call, shoot me a text, and we can definitely set up a time to talk.
Thank you very much, Ravi, for your time and for this amazing presentation and for sharing your expertise with us. And thank you, everyone, for attending this webinar. We expect you in future webinars. I hope you have a wonderful day, everyone.
Thank you.
Have a wonderful day. Bye-bye.